All right, today we are pulling back the curtain on financial analysis. We're going to show you exactly how the pros check up on a company's health. And you know what? By the end of this, you'll have the tools to do the exact same thing yourself.
So, picture this. Someone hands you a company's annual report. It's just pages and pages of numbers. It's like trying to read a doctor's chart in a language you've never seen before. Where do you even start to figure out if this company, our patient, is actually healthy or not?
Well, the answer is something called financial ratios. These are the vital signs of a business. They are basically simple calculations that take all those confusing numbers and turn them into crystal clear indicators of health. To show you how it works, we're going to perform a full checkup on our patient for today, a company called Agora Co. Limited.
So here's our game plan. We'll start with the short-term vitals. That's called liquidity. Then, we'll put its performance and efficiency to the test. After that, we'll take a hard look at its debt risk, see what the market thinks, and then we'll bring it all together for the final diagnosis.
Okay, so where do we begin? Well, just like a good doctor, we're not going to focus on just one single symptom. Nope, we're going to examine this company from a bunch of different angles to build a really complete picture of its overall health. First things first, we have to ask the most fundamental question. Can this company survive the next year? This all comes down to liquidity. Basically, its ability to pay its immediate bills. It's the most crucial vital sign we can check.
Liquidity ratios are kind of like checking a patient's pulse or their blood pressure. They tell us if the company has enough cash or things it can turn into cash really quickly to cover all of its short-term debts. And the most common one is called the current ratio.
Now, the formula here is super simple. We just take the company's current assets, that's stuff like cash, inventory, and money other people owe them, and we divide all that by its current liabilities. Those are the bills due within the next year, like payments to suppliers. So for Agora Co., that's $700,000 divided by $300,000.
And that gives us a result of 233%. So what does that mean? Well, it means that for every $1 Agora owes in the short term, it has $2.33 in assets ready to go. A ratio over 200%, or 2 to 1, is generally seen as really healthy. So, first vital sign check, Agora's pulse is looking strong.
Okay, with those short-term vitals looking good, we can move on to performance. How well is this company actually running its day-to-day business? We'll find out by checking its activity and, of course, its profitability.
You can think of activity ratios as the company's treadmill test. We want to see how hard its assets are actually working. I mean, are they just sitting around collecting dust, or are they being used efficiently to generate sales and make money?
A really key metric here is the total asset turnover. We take total sales and divide by total assets. For Agora, that's $3 million in sales coming from $2 million in assets, which gives us a ratio of 1.5. This means for every dollar of assets it owns, we're talking factories, equipment, inventory, it generates $1.50 in sales. Now, whether 1.5 is good or bad really depends on the industry, but it gives us a great baseline for how efficiently this company's operating.
All that activity is great, but here's the real question. Does it actually lead to profit for the owners? That's where profitability ratios come in. And probably the most important one for shareholders is return on equity, or ROE. It answers a very simple question. For every dollar I've put into this company, how much profit did it actually make?
Agora's ROE is 12%. This means for every $100 of shareholder money invested in the business, the company generated $12 of net income. Now, for some context, an ROE between 15 and 20% is often considered pretty good. So while Agora's performance here is decent, it looks like there might be some room to improve. So the company is healthy in the short term, and it's performing pretty well. But what about the long-term risks? What's hiding under the hood? Now we need to look at how this company is financed. Specifically, how much debt is it carrying?
Leverage ratios tell us just how much the company relies on borrowed money. You see, debt can be a great tool to amplify returns, but it absolutely adds risk. Too much debt can be really dangerous for a company's long-term health, so this is a critical part of our checkup.
A key leverage metric is the debt-to-equity ratio. It's simple. It compares the company's total debt to the total equity that's been invested by its owners. For Agora Co., the numbers are identical, $1 million in debt and $1 million in equity.
That gives us a ratio of 100%, or 1 to 1. This means Agora is financed exactly half by debt and half by its owner's equity. Now, this 50-50 split isn't necessarily a huge red flag. It's actually pretty common in a lot of industries. but it does tell us the company carries a pretty significant amount of financial risk. This is something we definitely need to remember for our final diagnosis.
We've done our internal exam. Now it's time to get a second opinion. How does the outside world, all the investors in the stock market, how did they see Agora Co.'s health and its future?
Market value ratios are really fascinating because they connect the internal numbers from inside the company with the external, real-time judgment of the stock market. They give us a sense of whether investors are feeling optimistic or pessimistic about where this company is headed.
Two of the big ones here are the PE and PB ratios. The price-to-earnings ratio tells us how much investors are willing to pay for each dollar of profit the company makes. A high PE might mean investors are expecting big growth in the future. The price-to-book ratio compares the stock price to the company's net asset value. So if the PB is over 1, it suggests the market thinks the company is worth more than just its physical assets, probably because of things like brand recognition or tech. These ratios give us a really powerful snapshot of investor confidence.
All right, we've run all the individual tests. We checked the vitals, we looked at performance, we assessed the long-term risk, and we got the market's opinion. Now it's time to put all the pieces together for our final diagnosis.
A really powerful tool for this is called the Pont System, and it shows how everything we just talked about connects. It breaks down that key metric, return on equity, into its 3 core drivers. First, how profitable the company is. Second, how efficiently it uses its assets to make those sales. That was our asset turnover. And third, how much financial leverage or debt it uses to juice the results. These are the 3 levers that ultimately drive shareholder returns.
But before we wrap up, a really crucial word of caution. Like any single medical test, no one ratio tells you the whole story. You have to remember, these numbers are all based on what happened in the past, not what's going to happen in the future. Different companies can use different accounting rules, which can make comparing them really tricky. And a single number all by itself is pretty much meaningless. You always need context.
So, our checkup is complete. We've seen that by using just a few key ratios, you can go from total confusion to real clarity and actually diagnose a company's health. The next time you look at a business, you've got the tools. So let me ask you, what's the first vital sign you're going to check?